Stocks, finance, stocks, money, stocks. Do I have your attention now? Today, we're talking about a stock in my personal favorite sector right now, cloud cybersecurity. It has a great balance sheet, Rona invincibility, some awesome partners, and so much more. Let's do it. What's going on, everybody? My name is Matthew. Welcome back to my channel, and today we are talking all things CrowdStrike. This is a very exciting cloud cybersecurity stock, so let's jump right into the format. First, as always, an overview of CrowdStrike. Second, it's not a cheap stock, so how do we evaluate it? Third, their juicy financials. And finally, fourth, what am I going to do? I know it sounds like a lot, but don't worry, we'll make it snappy, hopefully entertaining, and let's get right into it with part one. What is CrowdStrike and what do they do? We'll just call it Crowd for this video. Crowd was founded in 2011 to, quote, reinvent security for the cloud era. Back in 2011, CrowdStrike saw that the world was changing, i.e. a movement to cloud. However, at that time, they thought we don't have a seamless security system that could help support a movement to cloud, so the co-founder and CEO, George Kurtz, who previously worked at McAfee, another security system, decided to make one. CrowdStrike has a subscription-based business model, and they are what's called a SaaS company, or software as a service company. And SaaS companies usually have very high gross margins. But among the plethora of cloud stocks out there right now, what makes CrowdStrike different as a company? Well, a lot of things. And aside from the fact that most of the cloud cybersecurity stocks are different because they protect different areas of the business and different threats, CrowdStrike is different because it's a 100% cloud-based service, aka cloud native, as opposed to the traditional on-premise security systems. In other words, CrowdStrike is completely deployable from the cloud, whereas many of its direct competitors still require on-premise service, which means like physical installations or maintenance or hardware, stuff like that. By being cloud native, CrowdStrike systems seamlessly integrate into the remote working dynamic, where cloud cybersecurity has only become more critical as more sensitive material is traveling through the interwebs than ever before. Another differentiator for CrowdStrike as a vendor to other customers is that they provide a whole suite of different services, or what they call modules, for cybersecurity. This makes CrowdStrike very attractive to potential customers because it means they can replace their existing several vendors who are all doing different jobs with one installation of CrowdStrike, who will get rid of all of those vendors and do all of their jobs. Exhibit A, where CrowdStrike helped replace 4 other security software vendors and significantly streamline operations for a food conglomerate. Another key attribute of CrowdStrike is that it is heavily AI powered, meaning it uses artificial intelligence and machine learning to better understand your business, your company, and how to better protect it. And if you're not already familiar, machine learning is essentially when AI gets smarter the more data you feed it, and CrowdStrike has a ton of data to feed its AI, as it captures over 3 trillion events every single week. Stay with me here, we're still chugging through part 1 of this video, but all this information is very important and we'll get to the other parts very soon. In my research, I read through this entire transcript and I've picked out some gems for you, so all I ask is that you gently tap that little like button in the bottom, let's see, left, right, your right, my left. CrowdStrike's pretty much invincible to the Rona. In reference to the stay-at-home trend that we've seen during this pandemic, CEO and co-founder George Kurtz said that, quote, we believe these trends have helped increase our leadership in the security cloud category that we have pioneered, end quote. They also transitioned 100% of their workforce to be remote. 100%, and they still had a blowout quarter. That's partly in thanks to the fact that 70% of their team is normally remote anyways. So as a mini recap, this whole global situation increased their business, barely affected their workforce. In fact, they're actually hiring more people. And finally, in this conference call, they talked about their partnership with Amazon Web Services. This led me to dig deeper into their other partnerships, and I was pleasantly surprised to find that in 2019, CrowdStrike partnered with Zscaler, another leading cloud cybersecurity company, and they also launched CrowdStrike Falcon for AWS, aka the juggernaut, Amazon Web Services. All right, that's all great and all, but this stock ain't cheap. It's hard to evaluate growth stocks already, and even harder in today's market, so let me show you exactly how I decided to value CrowdStrike in part 2. Well, yeah, how I evaluated CrowdStrike. So when a company doesn't have any earnings yet and we can't use the PE ratio, we can use something called the price to sales ratio, which is just market cap over revenue from the last 12 months. This ratio essentially shows us how much the market values every dollar of the company's sales. We can use the price to sales ratio or PS ratio similarly to how we use the PE ratio. The concept stays the same. If the PS ratio for your stock is a little higher than the other ones in this industry or competitors, it might be a little overvalued and vice versa. Of course, you should always use the PS ratio in tandem with a bunch of other financial metrics before you make your final conclusion, but enough of that, let's take a look at CrowdStrike's PS ratio relative to the other people in this industry. As of July 8th, CrowdStrike has a PS ratio of 38.55, which is historically quite high when we look at CrowdStrike's history, and this just says 41 because Yahoo data is often a bit late to the game or just off. I got the 38.55 figure from a website called YCharts, which updates the PS ratio daily. So yeah, historically speaking, the PS ratio for CrowdStrike is a little high right now, but however, despite this, if you compare it to the other cloud cybersecurity stocks out there, it starts to look a little less crazy. Zscaler has a PS ratio of 39.43 and Okta has a PS ratio of 40.98. So it's not cheap compared to its peers, but it's also not expensive, and it's pretty much just right on par, and I don't see this as either a good thing nor a bad thing. Another way to evaluate the growth or progress of a SaaS stock, and remember that software as a service, is something called the Rule of 40. And put it very simply, the Rule of 40 is calculated by adding a company's percent revenue growth and percent profit margin. If this sum is over 40%, you have yourself a contender. So on June 12th, 2020, about a month ago now, Jim Cramer, the host of Mad Money, listed out a bunch of SaaS stocks that he likes that also passed the Rule of 40, and you guessed it, CrowdStrike was on that list. CrowdStrike absolutely crushed it, coming in at 61%, destroying the 40% benchmark, but you know who else was on that list? Livon Gains, baby! Livongo is a stock that has treated us very nicely since I first spoke about it on this channel about a month ago when it was around $63 per share. And now, as of today, June 9th, 2020, it crossed $107 per share. So congratulations to all of my Livon Gains long-term holders. But back to the topic of this video, CrowdStrike, which absolutely crushed the Rule of 40. But I should remind you, you should use a lot more things than just the PS ratio and the Rule of 40 to make your evaluation. Those are just the two I want to talk about in this video. Okay, so we know what the company does, why it's a leader in its industry, why I think it has great potential for the next 5 years, how it's Rona proof, and we have a decent valuation on the company. But here's the question. Do its financials check out? Here's part 3, the juicy financials. I really like their balance sheet, but I'm gonna save that for last because I think it's a treat because I'm a finance nerd now, and that's just how things are. Absolutely huge year-over-year revenue growth from $85 million to $162 million. Meanwhile, their margins slightly improved. As you can see, their total cost of revenue did not increase proportionally with their revenue increase, and this is good. That means their margin is getting better. In their earnings call transcript, I actually found that the CFO highlights that they will be continuing to increase their margin over the long term by, for example, lowering the cost of their data centers, but in the near term, the margin will likely fluctuate. Now, SaaS companies are already well known for having great margins, but it's never a bad idea to just bump it up a little more. They do still show a net loss, but they gave guidance in Q1 for a near break-even quarter in upcoming Q2, which means profitability is probably well within reach. One reason why it might not be profitable in Q2 is because they're actually entering a pretty aggressive hiring cycle right now, meaning they're adding more personnel to their teams and their R&D and stuff like that. Ladies and gentlemen, it is time for the balance sheet. Just look at that insane stockpile of cash. $1 billion in cash on the balance sheet, nearly quadruple what they had a year ago, with current assets at $1.25 billion and current liabilities of $555 million. CrowdStrike has a nice current ratio of about 2.25. Remember, we like that above 1 because it indicates good financial health for the next year. They have $1.5 billion in total assets and about $766 million in total liabilities, which is also awesome. But here is the kicker. Of their $555 million in current liabilities, about $465 million of that, or nearly 84% of their current liabilities, is deferred revenue. This just means CrowdStrike has customers who have paid for a service that has not yet been fulfilled. CrowdStrike is liable to fulfill these services before they can take that deferred revenue and count it as actual revenue. While as a subscription-based business model, that deferred revenue, which just adds to the scary liabilities number, is actually a pretty harmless number in my personal, in my personal opinion. Because they're subscription based, most of this deferred revenue is just, for example, say a customer who paid for an annual plan on CrowdStrike's security systems, but that annual plan still has 6 months left. So technically that 6 months is still counted as deferred revenue, but it really isn't like a dangerous liability like debt. So hypothetically, if you took out all of their deferred revenue from their current liabilities, which by the way, it's not that black and white, you really shouldn't do this, but hypothetically, to give us a better picture, you'd only be left with $90 million in current liabilities compared to their $1.2 billion in current assets. Wowza. Wow. All in all, I like how their financials look. All right, so what am I doing with CrowdStrike? So you should know I'm a pretty big bull for the cloud sector. I think it's one of the huge overarching trends for the next 5 to 10 years, just like electric vehicles or AI. I think cloud is right there. I already own ZS and I already own Okta. And I'm actually in a state of my portfolio where I'm trying to reduce the number of different positions and stocks I have, but I like CrowdStrike so much that I'm going to start a position with them. Everyone who is a top tier patron on the Patreon and in the Discord will be notified of exactly when I do start this position, just like they're notified every time I buy or sell a stock. And if you want a link to that, it's in the description below. It's the Patreon link right there. So you might be wondering,
but Matt, CrowdStrike just hit all-time highs.
Well, yes, they did. And I'm fully aware of that. However, I'm at a pretty young age where I'm comfortable, taking the risk of buying into a growth stock at an all-time high because one, my portfolio's goal is fast-moving, aggressive growth. That is my personal goal for my portfolio. Two, I'm at a young enough age where I know I can hold these stocks for 40, 50 years even. And buying an all-time high now probably will look pretty cheap decades from now. But if your portfolio's goal is not aggressive, fast growth, or it's more risk averse and you don't want to take more risks like I'm willing to, or maybe you're at a point in your life where you're not willing to hold these stocks for decades upon decades, then you need to reconsider whether or not you're going to buy into a stock like this. And lastly, I don't want you to think I'm just buying willy-nilly into a bunch of different stocks that I like. I actually have a plan in my mind where I know I'm going to be able to keep my cash at about 30% of my portfolio because I am preparing for a bit of a correction. I am bullish on the long-term market, but I am preparing for a correction. So please don't just do whatever I do. I'm saying all of this. I'm saying like my portfolio goals, my age, or my plan. I'm saying all this so you have a better perspective of where I'm at and why I'm buying now. So it doesn't just sound like I'm saying, oh, I like this stock, I'm going to buy it now, even though I have 2% cash in my portfolio. I'm just going to go all in. So that's to give you a little more perspective, and I hope this helps. And yeah, if you found any value in this video, and I hope you did, please make sure to hit that like button, subscribe, and stick around for a while. Take a look at the quote of the day. You might just learn something here, folks. And then go follow me on Instagram for daily posts about my portfolio, thoughts on the market, different stocks I'm looking at, and all that good stuff. Thank you so much for watching at this point in the video. You are the real MVPs. Don't forget your peace and thank yous.